Hey everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into a topic that's reshaping not just how we trade, but how the global economy itself functions. We're talking about AI, tech, ESG investing, and what they all mean for the future of finance. I'll break down how these forces are interacting with macroeconomics, changing the investing landscape, and creating both risks and opportunities for traders like you. And of course, I'll make it real, clear, and useful. No jargon, no fluff, and definitely no filler. Let's get into it. The AI effect on the economy. Let's start with artificial intelligence. AI has moved beyond sci fi headlines and into the core of how economies operate. It's not just about automation anymore, it's becoming a macro force. In fact, AI is influencing everything from GDP growth to central bank decision making to inflation modeling. From a supply side perspective, AI boosts productivity. It replaces repetitive human tasks, accelerates workflows, and helps businesses scale without massive headcount increases. This can drive economic growth even in the face of stagnant labor force expansion. From the demand side, it's a disruptor. AI changes the kind of jobs people do, which affects wages, income distribution, and consumption patterns. That matters because consumer spending makes up over two-thirds of most developed economies. And here's the macroeconomic twist. When AI speeds up decision making across industries, it doesn't just optimize operations, it actually compresses economic cycles. What I mean by that is this: markets react faster, businesses adapt faster, central banks analyze data and implement policy shifts with much less lag time. The feedback loops tighten. That increases volatility, but also efficiency if you're positioned well. There's an excellent episode on this in the AI Impact on Economy podcast, hosted by Crystal Ball Markets. Highly recommend it if you want a digestible yet deep dive into how AI is shaking up macroeconomics. Now, for traders like us, this has direct implications. AI changes market structure. It influences pricing models. It even shifts how risks are assessed. We're entering an era where understanding machine learning models might be as important as understanding technical chart patterns. The future of finance technology. Next up, fintech and how the tools we use to trade are getting a serious upgrade. Finance is being re engineered from the ground up. What used to be slow, opaque, and exclusive is now fast, transparent, and accessible. The future of finance tech rests on four big pillars: AI powered decision making. Think algorithms that process news, analyze sentiment, and detect market inefficiencies before humans even spot them. Platforms are starting to integrate these features right into the user interface. Decentralized finance, or DeFi, blockchain based systems are eliminating middlemen. Peer to peer lending, tokenized assets, and smart contracts are giving more control to users and reducing transaction costs. Personalized investing. Your trading dashboard is no longer one size fits all. Now, it can adjust in real time based on your risk profile, trading history, and even behavior patterns. Live risk management tools. You can monitor your exposure, test different hedge setups, and execute contingency plans on the fly. This level of control used to require a full desk of quants and analysts. All of this empowers the retail trader. That's why I want to shout out the Crystal Ball Markets trading platform. It's world class, powerful, yet user friendly. It gives you pro level tools without the institutional gatekeeping. If you want to level up your trading experience, that's a great place to start. Go take a look. It's built for serious traders who want serious results. Tech plus macro, the feedback loop. Now, let's talk about something subtle but hugely important: the feedback loop between tech innovation and macroeconomic policy. When tech boosts productivity, GDP can grow without the usual inflationary pressures. Central banks may keep interest rates lower for longer. That's bullish for equities. Then, that growth attracts capital, which pushes valuations higher, especially in tech heavy sectors like software, semiconductors, and renewable energy. That in turn funds even more innovation. But there's a flip side. If the pace of tech adoption is uneven across countries or sectors, it can widen economic inequality and increase systemic risk. Entire industries can become obsolete overnight. entire economies can fall behind. What does that mean for us as traders? It means that we can no longer ignore the macro landscape or the tech cycle. You've got to stay educated. Podcasts like Crystal Ball Markets do a fantastic job at unpacking these trends in a way that's clear, actionable, and honestly, pretty engaging. ESG Investing Explained. All right, shifting gears to ESG, environmental, social, and governance investing. This is more than just a feel good movement. ESG is becoming a new standard for evaluating risk, resilience, and long term value. And it's now squarely in the macroeconomic spotlight. Let's break it down. Environmental. This includes how a company manages its emissions, energy use, and sustainability. With carbon taxes and climate regulations on the rise, this isn't just good PR, it's a bottom line issue. Social. Think labor rights, diversity, community impact. Companies with poor social scores are more likely to face lawsuits, scandals, or reputational damage. Governance. This is about transparency, board oversight, executive pay. Good governance reduces the chance of fraud, corruption, or regulatory penalties. The macro angle? Regulators, especially in the EU, are starting to require ESG disclosures. That means ESG performance is becoming part of mainstream valuation models. And institutional investors are already flowing into high ESG portfolios in a big way. Companies with strong ESG scores tend to have lower cost of capital, higher customer loyalty, and better long-term returns. That makes ESG not just ethical, but profitable. If you're not yet sure how ESG fits into your trading or investing strategy, check out the Crystal Ball Markets podcast. Their episodes break down ESG investing clearly and show how it's connected to real-world market shifts. How to invest smarter in a tech-driven world. So let's bring it all together. Here's how to invest smarter in this rapidly evolving, tech-driven, AI-powered financial world. Zoom out and think macro. Understand the global forces shaping sectors. Don't just look at stock charts, look at central bank policy, AI developments, ESG scores, and energy transitions. Use the best tools. The right platform can give you the data, analytics, and execution speed you need to compete. Again, crystalballmarkets.com is a great place to start if you want a clean, powerful trading interface with serious functionality. Stay educated, listen, read, question everything. Markets evolve. Don't let your knowledge go stale. I love the Crystal Ball Markets podcast for its balance of simplicity and depth. It's perfect if you want to build real understanding without needing a finance degree. Final thoughts. So here's the bottom line. The intersection of AI, ESG, and fintech isn't some future concept. It's already here. It's baked into how economies function, how capital moves, and how opportunities emerge. The smartest investors and traders out there aren't just watching the trends, they're positioning for them. They're learning the tools. They're building context. And they're acting with clarity. If that's where you want to be, don't wait. Check out the Crystal Ball Markets trading app. It's cutting edge, intuitive, and built for real-world trading performance. And definitely subscribe to the Crystal Ball Markets podcast for smart, grounded insights on trading, AI, ESG, and the macro landscape. Thanks for tuning in to Financial Market Insights for Traders. I'm Sophia, and as always, trade smart, stay sharp, and I'll see you in the next episode.